David Dowden, let's get a mid-year checkup on the muni market. And at the start of the year, you said it's going to be very volatile in bond land, and it turns out you were right.
Sure, and the volatility we've seen has been from several different sources, from credit, such as Puerto Rico, from concerns about what the Fed is going to do and when it will act, and then even events like Brexit. But in each occasion, what we've seen is that it's created real opportunities for us to find cheap bonds in the market.
All right, why don't you talk about the technicals of the market right now?
The technicals are actually very favorable for our market. We have a supply level that is very manageable. And when we look at the supply, you really have to break it down into two parts. Investment grade, high quality bonds, and then lower quality bonds, still investment grade, but offering more yield. And in that case, there's not that much paper in the market. And the demand is through the roof, $33 billion into mutual funds so far this year. A lot of investors coming into the market that aren't traditional muni investors. So what we're seeing is a very strong technical picture. We continue to see that going through the end of the year.
And when you made your forecast at the start of the year, you chose revenue bonds over GO bonds, and it seems like that was the right call. Will it continue to be the right call heading into the second half?
We think it will. We don't agree with the reasoning entirely. We think there are a lot of general obligation bonds that are attractive, but the general market is looking at how GOs are being treated in some of these crisis situations, Detroit, Puerto Rico, and they're worried about whether general obligation bonds are the credit that they think they are. Revenue bonds are much easier to understand and have secured revenue flows, so people are liking those more, and that's how we're invested.
And you like those revenue bonds associated with transportation, right? So talk about those heading into the second half of the year.
We've liked airports for the last few years. We think that the transportation sector is benefiting from strong economics as well as much stronger support from the federal government. We expect to see a lot more growth in that sector in terms of projects and ongoing demand for use of our transportation facilities.
All right, and your big call for the year was, in the spring, you liked high yield munis, and then you said when it comes to the second half of the year, in the fall, you said dial it down and come back to investment grade munis. So how is that working out for you?
Very well. High yield space is outperforming by several hundred basis points over investment grade bonds. But spreads have come in, and we think the next marginal dollar coming into the municipal market will go into investment grade bonds because people feel they're not being paid for the risk they're taking.
All right, one more question. We got an election coming up. How is the election, Trump versus Clinton, going to affect Muniland?
We don't think it's going to have that great an impact. There's always going to be some speculation about tax policy. There may be at the margin some adjustments, but overall we think that either candidate, either camp really understands the value of municipal bonds as a financing vehicle and an access point for the capital markets for state and local governments. We think the market's going to be fine.
All right, well, thanks a lot, David.
Thank you very much.
And thank you for watching The Street.